Do I own Walmart? Of course I own Walmart. I get these questions from time to time. Ian, do you own these stocks? And I did a video previously on, of course I own Coca-Cola. This is another one. Come on guys, of course I own Walmart. As a long-term dividend growth investor, I've been in the game for a long time. I've been investing for dividends and cash flow for over 20 years now. Walmart found its way into my portfolio a while ago, and I'm looking forward to analyzing Walmart today. I want to share my story with Walmart with all of you, what I think about Walmart, and in particular, how I compare Walmart against Amazon. I did some videos recently, I'll link in the description below, comparing growth investors versus dividend investors, growth investors versus value investors. And this video really epitomizes, in my opinion, the difference between a growth investor and a value or dividend investor like myself. So let's get started. So Walmart recently, I've been receiving so many questions about it because it just hockey sticked. It went up 10% in a single day. It's doing really well. And the reason it's doing well is because of their fiscal Q2 earnings from 2019 fiscal Q2. And revenue was up 3.57% on a constant currency basis. This is a really strong growth of revenue when the base here is really big. I mean, we're talking about in a single quarter, they drove nearly $128 billion worth of revenue, just massive scale at this company. The operating income was down. This is really important. I want to drill into this later, but Walmart, I actually haven't been buying this thing for a while. I mean, reinvesting my dividends, but I haven't been buying this. I bought this back. I bought this back starting in 2009, and I started purchasing in the high 40s, throughout the 50s, and also in the low 60s. Those are some of the ranges where I purchased this stock. Currently, it's trading at a price per share of $94. So this thing has gone up quite a bit since when I first started purchasing. The PE here is like a healthy 19. I feel like the company is fully valued for the current state of the company, at least. I think going ahead, there's quite a bit of opportunity here. But I'm not buying this company. I'm not buying this company in 2018 here, although I am compelled. I'm excited about these results. And anyways, we'll get into operating income later, but the reason it's down is this company is investing in the business, they're investing in their operations, they're hiring people, they're paying people more. It's not a gross margin issue. I actually looked at it. It comes down to the selling, general, administrative, marketing, sales type expenses. And so the reason the operating income is down is they are pouring money. They're pouring it into the business because they're going head to head with Amazon. Anyways, let's go on. Same-store sales are way up 4.5%, best they've seen in years, actually in a decade. And they gave guidance of EPS $4.90 to $5.05 for this year. Here's the deal. Also worth mentioning, e-commerce sales are just way up. They skyrocketed. E-commerce sales were up 40% year over year. The street just ate this up. People loved seeing this. And so anyways, I take the current price per share of $94.54. I divide it by the low end of their guidance, which is $4.90, right there in the denominator. I get a current PE looking at this fiscal year for Walmart of a 19.29. So that's a forward-looking PE, but it's based on this fiscal year on their guidance, and it's based on the lower end of their guidance. And so I think it's trading right now at a pretty fair valuation for a company like this, for a company that is going head-to-head with Amazon and facing a lot of competition right now. But I also think that this company is doing well, and so I want to drill in here just to a few things. I have my computer here. I took some notes. I could not fit it all on this whiteboard, so this is going to be a longer video today, but I think this company, this space, really warrants it because it's just a complex space, and I get so many questions about FANG stocks, in particular stocks like Amazon versus traditional dividend stocks. And so check this out. As I mentioned, e-commerce way up. Something worth mentioning. Walmart International drove $29.5 billion this quarter as well. So $29 billion out of the total of $127.8. Not bad. I love seeing that international exposure. And the reason sales were up, the reason the company is doing so well right now is based on their grocery division and some of their seasonal apparel as well. And I like this. I like seeing that their grocery division is doing well, because groceries, people need those on a regular basis. It brings people into the store. It helps people buy other stuff in addition to groceries. Even though groceries are a lower margin business, it gets people into the store. And so also why I like it is Amazon obviously acquired Whole Foods, and so they're going to see some competition here from Amazon. And the fact that they're doing well in groceries right now despite that head-on competition, I love it. I love that. So way to go, Walmart. So I want to go into some more stuff. The investment in Flip Kart. So Walmart is taking a different approach than Amazon. So obviously Walmart comes from a very traditional background, brick and mortar store, big box store background, and they've just garnered this huge lion's share of business throughout the United States and the world by employing a really solid business model and driving very low prices. They're able to negotiate with the producers of the goods that they sell in their store, and they're able to offer value to the consumer, and they've done well with this strategy, but it's had to evolve. Here comes along Amazon in this internet age that we live in right now, and Walmart is trying to not only catch up, but to surpass Amazon in some ways, going through the process of making a substantial investment in Flip Kart. This is the large e-commerce engine in India. Basically, I would say, from the best of my understanding, the Amazon of India. And obviously that is a hyper growth market, very fast growing market. So I like that they've done that. They purchased in 2018, or fiscal 2018, ModCloth and also Bonobos as well. So they've been making these acquisitions. And I like the ModCloth and Bonobos ones because here's the deal. They're purchasing these innovative clothing and apparel brands, and I imagine there's going to be just a huge amount of synergy between those e-commerce apparel brands and the physical storefront that Walmart offers. And so I think we look again, why are same store sales up? Why is the company doing so well in fiscal Q2? The reason it's doing well is from groceries and apparel, and it's nice to see that potentially some of these apparel acquisitions are driving synergies already for the company. So it's really exciting to see that. What else? I want to transition now away from fiscal Q2 and I want to go into fiscal 2018. I read their annual report. Anyone can do it. Real easy. If you're ever looking, I get a lot of questions. Ian, where do you get this information? How do you research companies? Do you go and read articles online? What do you do? I like to go straight to the source. So I went to the investor relations website for Amazon, but I do that later, but for Walmart. And I pick up their annual reports, their quarterly reports. I just read them through. I look at the high level stuff, but I also go into the numbers, into the income statements, balance sheets, all of that kind of stuff. And I can only fit so much on the whiteboard, so I got a wealth of info on my computer that I want to share with you guys as well. I'm going to go through some numbers later, in addition to just the high level. But basically, from fiscal 2018, just fabulous, $500 billion in revenue. This company drove $500 billion in revenue. That's pretty big. And for this year, for 2018, I don't think this is fiscal 2018. I think this is what I pulled from Yahoo Finance, the consensus analyst estimate. I think they're probably looking, I don't know, maybe fiscal or calendar. I'm not sure what they're looking at, but they're estimating for the 2018 year, the analysts on average are estimating that this 500 goes up to 515. So they are above 500 billion in revenue. That's a pretty large operation in the scheme of companies in the entire world. Operating profit or operating cash flow, sorry, not operating profit, cash flow, 28.3 billion. This is something that they highlighted. So they seriously have some serious cash coming through. But you'll see later, the operating margin and the operating profit has actually been falling over time. We talked about that a bit earlier. You see it up here just in fiscal Q2. And the reason, again, is these guys are being forced basically to invest in their business. Is that the right thing? Is it the wrong thing? Well, hey, it is what it is. I think it's the right thing given the situation that we're in. I think Amazon is just playing a different game. We'll see that later. They're not in a game of driving a lot of profit right now, and so they are pouring all of their money into innovation. And so Amazon or Walmart is doing the same, and it's lowering some of their operating margins. But anyways, operating cash flow is still really strong at 28 billion. Not bad. So e-commerce. E-commerce for Walmart in fiscal 2018 was 11.5 billion. It'll be really interesting to see what fiscal 2019 holds. We already know that e-commerce is up 40% year over year in fiscal 19 Q2. So it's going to be quite a bit higher than the 11.5 billion that they did in 2018 fiscal year. And so this is really the future of Walmart, or part of the future. And they talk about this in their annual report. By having customers on e-commerce who also come into the store, these are really solid customers who on average buy a lot more from Walmart than just the average customer who comes through the door. And so there's a lot of value here to this e-commerce strategy above and beyond just, hey, let's do e-commerce so we can compete head-to-head with Amazon. No, by driving e-commerce, it's helping Walmart's traditional business. And so I really like to see that. They're doing dividends and repurchases. We'll talk about Amazon later, but one of the key differences here is Walmart pays a dividend. It's not a very high dividend. It hasn't been growing very quickly as of late. And the reason it hasn't been growing is quite frankly because they've been using a lot of their cash to reinvest in the business. I think it's the right thing. I think long term, I'm looking 20, 30 years out, the opportunity for very hefty dividends is there. That is not the time for it right now just because of the cutthroat business, the battle that they are in against Amazon. So I think they're making the right choice. But for someone who needs cash flow right now, in 2018, this one does not provide a lot of cash flow, and I'll get into that later. But the current yield, I didn't write it here, but I got on my computer, I think it's around a 2.2% or something like that, quite low. Anyways, moving on, 10.1 billion capital expenses. So this is CapEx in terms of typically store-related CapEx. I imagine they're investing a lot of money just improving stores. And worth noting, they have 11,700 stores in 28 countries. So one of the things that I think is really important to mention here is if one is considering an investment in Walmart, you are investing in a traditional retail business. They have a lot of stores. Yeah, they're going digital, but out of their 500 billion in revenue, 11.5 came from e-commerce. So it's still a drop in the bucket. It's growing really quick at 40% year over year, but it's going to have to grow a lot more. It's still the lion's share of this business is traditional retail. And the way I look at it, I've discussed this in some of my other videos about dividend investing. I like a well-balanced portfolio, and I like representation typically from most of the major sectors out there. The reason I own Walmart at the end of the day is I want exposure to retail. And yeah, I've got exposure to retail. I've discussed some of the other stocks that I own, such as Starbucks. But the fact of the matter is Starbucks, it's more like a restaurant than traditional retail. This is traditional retail. And I want some exposure to retail in my portfolio for the sake of diversification. The reason I like Walmart is I think they're taking the right strategy. Yeah, they didn't build their tech from the ground up like Amazon, but through acquisition, through Flip Kart, through Jet.com, through Bonobos, ModCloth, etc., they are slowly but surely making it. They're building their internet division, they're building their technology division, and even Walmart Labs. Living here in Silicon Valley, I know that a few years ago they just recruited some of the best and brightest minds in this area to work at Walmart Labs. And at that time, actually, I was getting recruiters all the time contacting me, Ian, do you want to work at Walmart Labs? And I did not take that route, but nonetheless, I respect what they're doing there. And again, the cost of running the business is going up because they're bringing in all that talent, and operating profit is down, but that's the talent that's going to be needed to compete head-to-head with Amazon. And so I want to point something else out here. The market cap. This is really important. The market cap or market capitalization of Walmart. You take all the shares outstanding, multiply it by the share price, $94.54. What's it worth? $279 billion. So really big company, real big company. And I like owning big companies in my portfolio. I like small ones too. I like to diversify, but if I'm in retail, boy, I'm going to own a big company. I'm not going to own a small company in retail. It's just too risky. We talked about L Brands. I'll link in the description below. I don't own L Brands, and I will not be purchasing L Brands. And one of the reasons is this scale. Retail is a hard business, and you're seeing it right here with Walmart in their competition with Amazon. Difficult business, but something of this scale, I love it. And so anyways, I calculated, what is this thing trading on a multiple of revenue? Well, what I did is I just took all the revenue, 500. In fact, no, I took the 515, I took the forward-looking revenue, and I look, okay, well, that's the revenue. What's the market cap? 279. So I take the market cap, I divide it by the revenue. As a multiple of revenue, this thing is trading at 0.54 revenue. They're trading at half their revenue. Half of their revenue. Remember this number, because when we get to Amazon, you're going to see something very, very different. Anyways, I want to go into some numbers now on Walmart that I wrote down. So revenue in 2018, we already know, fiscal 2018, 500 billion. What was it when you look back? When I pull up their annual report all the way back in 2014, it was 476 billion. So it's grown. It's grown though only 5% over that time. So over these 5 years, it's grown 5%. Is that very good? Is that very fast revenue growth? No. And one of the reasons I have not really been adding to Walmart as late is quite frankly, they hit a difficult time. The stock price actually has recovered quite a bit. Like I said, I bought this thing as low as the high 40s. And so do I really want to be adding in shares at 94 when revenue's only been up 5% in the last 5 years? No. That being said, I feel good owning it. It's a turnaround play. Look, any company that one owns for a long period of time faces transition. This is a time of transition for Walmart. They've had good years. They've had more challenging times. This is more of a challenging time, but it seems like they're starting to come out the other end of all of this. And anyways, with revenue up only 5% in the last 5 years, not great, but look, it's up now, constant currency 3.57 year over year. Let's see if that trend continues, and let's see if e-commerce can continue to push revenues. What else? Operating income. When I look, this is a really important metric. I like to be real transparent and unbiased here on my YouTube channel and just share reality. And one of the things that I'm faced with when I look at this company is, look, operating income's not that good. Operating income in 2018, fiscal 2018, was 20.437 billion. Obviously a lot of operating income, but if you go back to 2014, it was 26.872 billion. Operating income is down 24% over the last 5 years. 24%, and you see it up here, it's down 5% just year over year. It's tough. It's a tough business. And again, this is why I don't buy companies like L Brands. The reason that Walmart operating income is shrinking, quite frankly, in my opinion, is the head-to-head competition with Amazon and the need for these people to invest in their business. And Amazon is just playing a different game. They don't try to make money. They're trying to basically drive very low profit. They're reinvesting in their business. They may be even doing things irrationally. And they have the support of the entire investing, FANG stock, venture capital. Everyone's on board. Everyone's on board. And it kind of creates this self-fulfilling prophecy almost. It's like, hey, Amazon's the greatest. Amazon's got all the money. We're going to drive. It doesn't matter if we don't make money. We're not in business to make money. We're in business to scale revenue and just take over worldwide domination. At least that's what it seems like the strategy is. Eventually, I bet you they'll try to carve out some nice profits, but that's not the story now. Because that's Amazon's approach, these guys can't just sit around and drive profit now. It kind of is interesting, but because Amazon, because that's their game plan, because the market rewards it, because the VCs, the investors, the FANG stock lovers of the world, everyone, they love it, they support it. Because of that, Walmart can't drive the kind of profit that they used to drive. And so it's this self-fulfilling prophecy. It's driving other companies to squeeze margins to compete. And look, at the end of the day, it's the cards that have been dealt. If Amazon weren't there, would this company be a lot bigger than it is now? Would it be trading at half its revenue? No, it would be a lot bigger, and it would not be trading at half its revenue. And so anyways, fact of the matter is that's the reality. I think long term, at some point, Amazon has to drive a meaningful profit. And when they start doing that, they won't be as cutthroat as they are now. and it won't be as harsh of a battle as it is now. At that time, I think Walmart's margins will start to expand again. And at the end of the day, maybe this whole Amazon thing is good for Walmart because it's forcing them to really show the world, Walmart, what are you made of? Can you survive in this crazy time with this crazy competition? It's tough. But anyways, that's why operating income is down. What else? Operating margin, just worth noting, what was it in fiscal 2018? It was 4.08%, low margins. This is a low margin business. It's worth noting retail at this scale that they're at, or at any scale, is traditionally a pretty low margin business. And so gross margins are great, but operating margins are low. And so it's just worth noting that operating this kind of business, it comes with lower margins. It's something that comes with the territory. It's one of the reasons you probably even sensed it in the video, I don't get excited about Walmart or Amazon, quite frankly, the way I get excited about some of my other companies that are like consumer non-cyclicals, other companies that have just higher margins. And so this isn't a very high margin business. Like I said, I wanted exposure to retail. What else? Earnings per share, you're gonna get a kick out of this. 2018 versus 2014, the earnings per share is down 32%. The reason it's down, again, is largely because of operating margins shrinking. And that being said, it's really starting to come back at this 4.9 range to 5.05. That actually would be, if they come in at the top of that range, they'll actually be the highest it's been out in the last 5 years. And so the highest comparable they have is 2015, where the EPS was $4.99. So if they can come in at like $5 or up, they're finally recovering that EPS, and it's not quite as bad as it was. So, anyways, that's that. Here's where it gets interesting. Here's, at the end of the day, why I like Walmart. One of the reasons, at least, other than just valuation, why I like Walmart. I like Walmart because they're dual strategy. They've got online and offline. And there's real value in physical real estate. I work in the real estate industry, in commercial real estate. I know the value of physical real estate. And if you look at their balance sheet, inventory, they've got $43.7 billion in inventory. I don't really count that as having much value, but they're churning through a lot of inventory, so there's some value there. But check this out. Property, equipment, capital, lease, and financing obligation assets. True assets here, $114.8 billion. Oh my gosh, they're trading at just over 2 times their assets. And so, and look, they don't have a lot of debt. This is another thing I love about Walmart. Long-term debt, $36.8 billion. These guys have managed a tight ship. And here's the deal. Going head-to-head with Amazon, it's going to be tough. It's going to be a fight. It already is. You don't want to go into that kind of fight with a ton of debt. You really don't. Walmart, bam, $500 billion revenue, $28 billion in operating cash flow. They can wipe this long-term debt of $36 billion out pretty easily. And so I love the fact they don't have a lot of debt, and they got over $100 billion in property and the value there. And so that is value that Amazon just doesn't have. Yeah, they got Whole Foods, maybe they got a few other storefronts, but they don't have, bam, 11,700 stores. And so if Walmart can just crack the code when it comes to online, they can keep up this 40% growth, they can get e-commerce up there. It doesn't have to be as big as Amazon's e-commerce, but as long as it really surges, continues to do well, this company, I think, is positioned so well with that dual strategy. And can Amazon ever replicate what Walmart has in real estate? I don't think so. And at the end of the day, as a value investor, dividend investor, that's why I like Walmart. Let's contrast this now. Let me contrast this with Amazon. So I got some numbers here. In 2017, the calendar year of 2017, Amazon did $177.8 billion in revenue. What are they going to do for 2018 calendar year based on consensus estimates from the analysts? They're going to do $234.9 billion. Okay, Amazon, you're doing $234.9 billion. Well, my Walmart is more than double you in terms of revenue. We're at $500 billion. This is the difference. But here's where it gets real interesting. Market capitalization. Amazon is trading right now at a market cap of $940 billion. Okay, Walmart's trading at a market cap of $279 billion. Remember, they're trading at just over half of their revenue. Okay, 940 billion divided by revenue for Amazon, 234.9, gives me 4x revenue. Okay, Amazon is trading at 4x revenue. Isn't that interesting? 4 times their revenue, where Walmart's trading at half of their revenue. That is quite a discrepancy in the way the market is evaluating these. And of course, Amazon is growing quicker, at least from a revenue standpoint. We'll see if and the other numbers, because they're just so small. But let's see if Amazon will ever drive this kind of operating cash flow of 28 plus billion, and will ever pay the kind of dividends that Walmart is paying now. I mean, look, they just did 14.4 billion in dividends and buybacks in fiscal 18. This is the difference between a FANG stock and a traditional dividend stock. You're getting half your revenue for a pretty good company, a pretty great company that has the retail footprint that is doing well in e-commerce, has the huge economies of scale, versus something trading at 4x revenue. Here's where it gets even more interesting. 2018 estimates. What's Amazon going to earn in 2018? They're going to earn 17.35 per share. Okay, $17 sounds like a lot, but it's not a lot because their price per share is $1,927. I take their price per share of $1,927, I divide by this consensus estimate, which is 17.35, I get a PE of 111. Price earnings ratio for Amazon right now is $111, whereas with Walmart, it comes in at 19. Okay, so we're seeing some wild discrepancies here on valuation. Would I ever buy a stock that is trading at a PE ratio of $111? No, I would not. I just would not do that. Would I ever buy a stock that's trading at 4x revenue when this one's trading at half a revenue? No. I mean, maybe I'd buy a stock trading at 4x revenue. I actually probably own quite a few of these in the portfolio, but they're companies typically that have sky-high margins. In the retail category where margins, we talked about operating margins, real low. We're in retail here. Whether it's online or offline, it's retail. Margins are thin. Am I going to pay 4 times revenue? No, I'm just not going to do it. And this is why I own Walmart and not Amazon. Want to go into some more numbers here with Amazon. Let's paint a good picture of Amazon, because there are some things Amazon has going for it, and it's really the growth. In 2017, we know that their revenue was $177.8 billion. If I go back to 2013, revenue was $74.4 billion. Their revenue is up 139% in these 5 years. Operating income, it's $4 billion in 2017. And in 2013, it's $745 million. So operating income is up 451%. That being said, it had a really low base. And look, to be fair to the Amazon people, $4 billion operating income, that's not bad. That's some good operating income. In fact, the operating margin is at a 2.31%, lower than the margins we're seeing at Walmart. Walmart's in 2018 was a 4.0%. Fiscal 2018 was a 4.08%. So Amazon's coming in lower than that at a 2.31. Could Amazon drive a higher operating margin and be more comparable with Walmart, maybe even a little bit higher than Walmart in terms of operating margin? Absolutely. I think they could take that up. And so the fact of the matter, they're doing all right on operating income. $4 billion is nothing to laugh at, and 2.31% operating margin. Given their historical strategy of being lean, not driving a profit, it's not bad. It's only going to grow. So it's got some things going for it. EPS is up 942% in the last 5 years. Again, though, it's kind of the law of low numbers. You're starting with a really, really low base. So here's where it gets interesting, though. We talk about balance sheet. A lot of assets at Walmart. If I add up inventory and property and equipment and such at Walmart, I've got 158 plus $1 billion in assets. If I just look at the property and equipment, 114.8 billion. A lot of assets at Walmart with very little debt, 36.8 billion. Assets at Amazon are only 39 billion by contrast. Their assets just are not very high. And their long-term debt is low, worth mentioning. It's only 6.8 billion. So the fact of the matter, on a balance sheet comparable, you got a lot more assets, a lot of assets at Walmart. You just don't have those assets at Amazon. And so when I just synthesize all of this, there's really 2 types of investors here. And look, I'm not buying either of these stocks right now. I like Amazon. I'm proud that I own it. I'm proud that I bought it back in the high 40s and then throughout the 50s and 60s. I started in 2009 is when I started buying dollar cost average in for a few years there, on and off. But I'm not doing it here in 2018, and I'm certainly not at a PE of 19. I think it's fairly valued. But the reason I'm doing this video is I love this comparison with Amazon because I get so many questions, and it just hockey sticked up 10% in a single day, so I get a lot of questions. But look, let's say hypothetically though, here's another reason this video is interesting. Let's say I was starting over again, had no retail in my portfolio. I need to add a retail. Would I make the same decision right now that I did before? Absolutely. If I was forced to enter the retail space in 2018, I needed to buy a retail stock, I didn't own anyone already, this would be where I would be looking. Would I buy right now at 94? Probably not. I'd probably wait for some kind of dip into the 80s, maybe even 70s. But that being said, this is how I think about Walmart right now. In retail, this is the one for me because it's the one that pays the dividends. It's the one that has the value. Speaking of dividends, the dividend right now is 2.08 per share, $2.08 per share per year on Walmart. I take that dividend, I divide by the share price of $94.54. I get a starting yield now of 2.2%. Real low starting yield. So it's just kind of lower than what I do. And the dividend, quite frankly, is only up 10.6% in the last 5 years. Reason the dividend growth has been slow is the same reason operating income is down. It is because they are reinvesting everything they can to win this battle, or at least to I don't know if there needs to be a winner, to come out so strong and to be a new Walmart and better, a new and improved Walmart. And so that's the tale of two investors. But quite frankly, I can't rationalize buying either now. I certainly can't rationalize paying 4x revenue and 111 PE. Just to me seems way out of whack. Maybe if this thing got cut in half, or even more than that, would I consider Walmart if I were a growth investor? But I'm not a growth investor. I invest for dividends and cash flow. I want to leave with a closing point today. This is a interesting point. As a dividend investor, I'm kind of going through an evolution here. And you've been following me for a while. You know, in 2018, started out the year focused on two stocks, Procter & Gamble, Kimberly-Clark. I'll link in the description below. Since then, those stocks and a lot of the other holdings that I have, they've just been doing really well. Share prices are up, yields are going down. I'm starting to kind of readjust my strategy here, that really the stage I'm at with my portfolio, I just can't really rationalize buying too many stocks unless the starting yield is getting closer to 4% at this point. At least high threes is nice. But when I start seeing companies like Procter & Gamble, Kimberly-Clark surge in share price, it's hard for me to rationalize buying them here at these current valuations. And so certainly the comparable here is like a Walmart. I can't be buying stocks like that at a 2.2% starting yield that are growing the dividend 10%, 10.6% in 5 years. Long term, let's say the e-commerce just takes off, the global stuff takes off, the tech investments take off, Flip Kart takes off, all of that. Maybe then they'll raise the dividend and it'll all be worth it. But the other side of me thinks, hey, Ian, I want a little more current income because I just want my dividend income short run to be higher because it gives me more opportunities to tap into the income, to use the income, and whenever I want. And so that's why I just can't be investing in something like a Walmart at a 2.2% starting yield. And quite frankly, I'm starting to rethink adding more to Procter & Gamble and Kimberly-Clark because they've gone up too much. And so I'm starting to look out there for other stocks, for values. And I've discussed some of these recently. A screaming value right now, in my personal opinion, is IBM. I'll link in the description below. I just started I've been buying the stock for a while. I started taking some bigger positions, averaging into it recently because of the valuation. And another one, Cedar Fair. This is a master limited partnership, publicly traded, starting yield really sky high. Link in the description below. I'm starting to look at those types of opportunities just a little bit more, starting to change my 2018 charter, if you will, intra-year, because of just some of these dynamics where I'm just having to search a little bit harder for value, and I'm having to go to stocks where I believe there is a deep value to find those dividends that are attractive. Whereas I was seeing broader based opportunity in dividends earlier in the year. Now it's just seeing like everything's gone up and it's just so expensive out there. And so I'd be curious, long video today, what do you think of Walmart, of Amazon, of some of these other stocks? Are you in? Are you out? What do you think about the overall market? Are you like me where it's kind of a little frustrating that the dividend stocks are going up in value and so it's harder to find stuff with a good starting yield? Kind of have to search a little bit harder for the IBMs or the Cedar Fairs of the world. I would be so curious what you are thinking right now in terms of dividend growth investing. If you enjoyed the video today, I please ask you to subscribe, to give a thumbs up, a like, a subscription, all of that. It just means the world to me. Comments below. We have a thriving community here on YouTube. We are dividend investors supporting dividend investors. This is such an amazing community, and I am so blessed. I'm really grateful for each and every one of you that is part of this community. And so before I leave today, just a friendly full disclosure here. I am long, I own the stocks mentioned today. So I am long, or at least some of the stocks mentioned today. I'm long, I own Walmart, ticker symbol WMT. I own Starbucks, ticker symbol SBUX. I own Procter & Gamble, ticker symbol PG, Kimberly-Clark, ticker symbol KMB. And I own Cedar Fair, ticker symbol FUN, and I own IBM, ticker symbol IBM. I am long, I own those stocks in my personal stock portfolio. I will link in the description below to videos about all of those. Before I leave today, a friendly disclaimer. Today's video is not investment advice. It is just for your fun and entertainment. I am not a licensed investment advisor. I'm just sharing my personal journey here on YouTube for entertainment purposes. If you're going to go out and invest in the stock market or anywhere else, please consult a licensed financial advisor first. Hey, if you made it this far, thank you for hanging in. I know a longer video today, but I've been meaning to talk about Amazon for a while. The recent surge in Walmart gave me a reason to talk about both of them, and I just have a lot to say on the topic. And so thank you if you made it this far. It means the world to me, and I really hope you enjoyed the video, and I'll see you. I respond to most of the comments, so I'll see you in the comments section below. And I will see you in the next dividend investing video.